here. I want to give you a quick update on what's going on in the real estate market for San Diego. So we've had some really positive shifts in interest rates. We're down about 50 basis points on average. So the average 30-year fixed is around 6.5%. That's a pretty big drop over the last couple of weeks. And the weird thing is that the federal funds rate, which everyone's laser focused on right now, hasn't changed at all. So the reason why interest rates have dropped so much is because it's being priced in to the market by investors. So don't expect interest rates to fall another 50 basis points when the Fed meets middle of September. They're likely going to drop the federal funds rate, like I said, 50 basis points, but it's already baked into the cake. So your credit card interest rate will drop, and your adjustable rate, all your adjustable rate, like HELOC kind of stuff, will drop. But interest rates, long-term rates, are not directly tied to the federal funds rate. They just tend to sort of mirror each other. So just want to keep that in mind if we're waiting to see how low rates will go. They may drop a little bit more, but they may not. And so we're going to see a slow drop in interest rates over the next several years, but 4% is probably not in the picture. So at some point we'll probably end up in the mid fives, but it may take a while. And the problem is that the more rates drop, the more demand there is. And you'd be surprised how waiting for that ideal rate, let's say 5.75, which puts you at, buying your dream home at that target monthly payment, you end up paying considerably more on the purchase price to secure that home, and you end up with a monthly payment that's kind of right back where you started because of appreciation. If rates stay at 6.5% or drop, we could see 5% appreciation in the real estate market in San Diego over the next 6 months. That is significant. And so if you are of a school of thought that feels that rates are going to stay at 6.5 or maybe even get lower, you may want to get into the market now, lock in your mortgage, and then benefit from the appreciation over the next 6 to 9 months, and then at 6 months later also get to refinance. You get the best of both. If you wait too long, then you're not going to be able to benefit from that situation. So something to keep in mind on the seller side, or on the buyer side. Right now, we are going to see the market shift over the next 6 months towards more of a seller's market. It's been a neutral or maybe even a buyer's market in certain segments. So what we may see is that you're going to see demand finally start to rise as inventory naturally falls throughout the rest of the year. The one weird thing right now with the market is luxury. Luxury has been sluggish over the last several months. Why is that? Well, they're much more tied to the ebbs and flows of the stock market. And so right now, there's been a lot of losses in the stock market. They're starting to recoup this week, but that really impacts supply and demand dynamics for real estate. So hopefully that is all helpful context for you about what's going on, and I'll talk to you on the next one.